Welcome, ladies and gentlemen, to our program on the financial world. So this is just a continuation, and it will be a summary. So today we're going to look at loans. So the previous video is simply based on the mortgage. We said a mortgage is the secured loan. After that, we did like the student loans versus business loan. Then I have the videos on the financial freedom. So all of this actually are based on the financial decision making. So this will be a summary on the financial making or financial decision making. So first of all, we're going to touch on the types of loans. It will be based in Europe or anywhere. It can be used everywhere really. The second point, we're going to touch on the key features of loan or loans. The third point, I'm going to give a practical example of loan in the real world of a loan. Then the fourth point, it will be based on the practical tips or procedures to take for taking out a loan in Europe, Africa, America, everywhere. Then after that, I'm going to give a quick summary at the end or quick conclusion, just as usually do in all the videos to sum up all what we learn in each video. So are you ready, ladies and gentlemen? Tighten your belt and let's begin. So in the case of loans, when we're talking about loans, it all depends really on the interest rates and the collateral. In the case of interest rates, are simply presented as a percentage, given as a percentage. In the case of collateral, just as we saw in the previous videos, it's all about security. It can be a private or business assets. It can be a car, something like that. Anything really which you have to give a lender or creditors before they trust you with their capital or money. So when we talk about loan really on the larger scale, let's say Africa, in the case of Africa, the government borrowing and all of that. So most of the government usually borrow to spend and not use in operations. So they borrow money, like in the case of many countries, even US, United States, or UK, United Kingdom, most of them have loans really, or large amount of money, most of the government, which is simply they buy to spend and not use in operation. They simply keep borrowing. And whenever you borrow money, the interest rates is always on the top. So the extreme case of interest rates is called usury, which is like an extreme really in the unexpected or giving unreasonable price of rates of interest. It's like the usury is the case of extreme cases of interest rates, higher rates. Then after that there's another thing as well. So I have to give some key topics the things which I'm going to talk here. So the fourth thing is like when it comes to paying loans, there's a penalty for early repayment. So for some people, really, you have to check before taking loan. You have to understand how you're gonna get a penalty because you paid your loans early. So if you have like 12 month time span to repay your loans, if you pay like before, let's say 20 or 18 months, so if like out of 24, you have like 4 months left. So if you pay early or repay early, then some types or some lenders can give a penalty. It's like you become a prisoner really. So if they give you 12 weeks or 12 months, you have to repay in that 12 months. So if you're paying too early, it's like a problem as well in the case of a loan or loans. So let's begin, ladies and gentlemen. Loans fully explained. Let's say in Europe, Africa, America, Asia, Australia, Oceania. So a loan is a financial agreement where a lender or creditor, in this case, provide money to a borrower. If you borrow money, you become a debtor. If you lend money, you become a creditor. So who agrees? The debtor, you agrees to repay it over a set period of specific time span, usually with interest. So the interest rate is simply linked with the loan. Is the money which you pay, the additional money which you pay on the top. So in Europe, the loan system functions similarly like to other parts of the world or various regions around the world, but varies based on the country-specific regulations. So when it comes in the regulations, it's all about the legal actions, laws and rules and things like that. So banking practices as well, they vary different countries, banking systems and interest rates structures. So each country have got their own regulations, their own banking systems, the central banks, and the rates as well. Some people have higher rates, some people lower rates. So if you, in the case of the government, if they put higher rates, in the case of inflation, if the interest rates goes up, that means you're discouraging the consumers or people from borrowing more money. If you lower the interest from 2015 5 to 0%, then you're encouraging more people to come to the bank and borrow money. It can be a public institution, which is a government owned, or private institution, which is individuals really, and the companies or businesses. So loans can be used for various purposes or reasons, such as purchasing a home or your own house, like in the case of mortgage here, like funding education, which is like personal for students, and starting a business, like business startup, business owners, or covering personal expenses. So those are like types of loans. You can borrow it for purchasing a house, which is a mortgage, a secure loan. You can take a loan for funding education, for the educations, students. We have done the video on all of that, loans and the mortgages, student loans, and the business loans as well, like starting a business. So I didn't do the video on the personal expenses as well. So that will be like on the types of loans, let's say in Europe or everywhere really, can be applied. So the first one will be like the personal loans in the case of types of loans. Personal loans. Some people should take loans for personal uses. It's not business related, it's not education related, no mortgage, just personal needs. So in the case of personal loans, like these are unsecured loans. In the case of unsecured, that means there's a lack of collateral. It's non-collateral. There's no guarantee, there's no pledge, there's nothing put in the case of a security. In the case of a lender, if you are lending money, there's no pledge. That means it is unsecured loans that individual can take personal for personal expenses or expenditures or personal spending. That's all about expenses really, such as the home improvements or vacations, sometimes marriages. Some people, if they want to improve their homes, they can take loans really just to complete the furnitures, the things inside the house, or buying a cooker, a fridge, things like that. Those are like the home improvements, maintenance and things like that, or vacations, going on vacations, visiting different countries and things like that. If you don't have enough money, then you can take a loan for personal expenses or personal uses. Sometimes marriages as well. Some people should take loans to cover up their marriages as well. So the repayment in the case of personal loans, the repayment are like fixed monthly payments of a set period. In the case of fixed, it's like the interest rates does not vary. It remain constant throughout the period of repayment. There's like the fixed rates. That just means it doesn't matter. It doesn't depend on the economic conditions or market conditions. The fluctuations up and down, it does not depend. It just remain constant. The same. There's the case of personal loans. The interest rates as well, the personal loans, like generally higher than secured loans because they are riskier for lenders. So in the case of interest rates, it's higher because there's no collateral, there's no security, there's no pledge. So there's more riskier for the lenders. So the lenders less trust in the data of the borrower. The second one is based on the mortgage loans. I've done the video on that. Go on the financial decision making playlist. I've put the video on that, mortgage in detail. So in the case of a mortgage, it is secure loans, which means the mortgage or the house itself, it acts as a collateral, which means as a backup. If in the case of default, when you cannot make all your full payments, or if you fail to repay, then the creditor or the lender will come and take the house, the property, which will cover as a loan in this case. They have to resell to recover the money which they are lent in the first place. So in the case of mortgage loans, like used to finance like the purchase of a property, can be real estate, house, or anything business related. So the property serves as collateral, as a security, as a pledge. That's all of the meaning of collateral. Meaning if the borrower defaults or fails to repay, the bank can repossess the home. So if you take a mortgage, you fail to repay your money, the bank will come and repossess or retake the home or the house. So in the case of interest rates and the mortgage loans, like can be fixed, which means it's like the rate stays the same for the entire term or the length of loan, or variable, which means changes with market conditions. So in the case of variable rates, like flexibility, adaptive, the fluctuations up and down, you pay the interest rates according to the market condition. So the terms as well in the case of mortgage loans, like typically longer or long, or in the case of term, long term really, spanning to 15 to 30 years. In the case of mortgage, you give them long time to repay the loan back. 15 years, 30 years, so it's like lifetime in that case. The third one is the car loan or the auto loans. So specifically for purchasing vehicles, that's all about cars, vehicles, things like that. So these loans are often secured by the car. In this case, it's the same like mortgage, because the car acts as a collateral or backup or security or pledge in this case. Meaning the lender can repossess the car if repayments are missed. So if you don't repay on the time, the lender will come and retake the car which they lend you in the first place. Same as the house. The bank will come and retake the house, sell it to cover the money which they lend you in the first place. So the initial money with the capital, it is called the principal. I've done the video on that on the case of mortgages really. Then the interest rates on the car loans is like often lower than the personal loans because the car serves as collateral. So it's the same thing as a mortgage or car loans. They're all the same. The car or the house serves as a collateral or backup. The fourth one is the business loans, which simply means in the case of business, you borrowing money just for business, no personal use. It's a business, a startup, or to improve your business, like a give and kick up in the case of bankruptcy and things like that. So in the case of business, like for startups or expanding your business, like making business become bigger and hiring more employees, maybe more people, more staff. So they can be secured or unsecured and maybe have variable, like varying terms based on the size of business and purpose. So in the case of business, they can be unsecured or secured, which means collateral can be present or non-collateral. And it depends on the size of the business and the purpose as well, really, the vision of the owner, the CEO, something like that. The repayment terms of the bank loans, the business loans, is like they vary significantly. It depends really, so fluctuates up and down. Often it's tied to the business revenue as well. In the case of revenue, it's all about the credit worthiness. How much are you making at the end of the year? Or the profit, things like that. The fifth one is like the student loans. So in the case of students, you just borrow money for education purposes, like tuition to cover your traveling, books, and accommodation, things like that. That's all about student loans. So you cover your term, full term maybe, or full year. So loans to secure education costs, that's all about student loans. In Europe or some countries as well, like Germany, offer interest rates or interest-free loans or high subsidized education. So in the case of Germany, they offer like interest-free loans, which means zero interest loans, or subsidized education as well, or highly subsidized education, which means fair price. So like other countries like the UK, United Kingdom, have higher interest student loans. In the case of UK, the interest rates for students is higher compared to Germany. So repayments as well, like start once the borrower's income reaches a certain threshold. In the case of student loans, I've done the video on that, the comparison between the student loans and business loans. So the student loans, you start repaying when you start to have some income, or when you reach a certain threshold or maximum point in this case. So the government usually go easy on the student loans than the business loans. And the previous video I said that the student loans are non-collateral. You don't need any backup. The student does not need to have a house or car. So just all you need is just have to go to the university or the college, which is known by the government or in the country. Then the government are going to support you as well. So in the case of business, you can have angel investors as well. People can be private or public, financial aids as well, government-backed or individuals or companies. So the second point, we're going to look at the key features of loans. The first one is like the interest rates. So whenever we're talking about loans, you have to pay the interest rates. It's like the money on the top as well. It can be 5%, 10%, 20%. It can be higher, 1.8, 1.5. 2%, it depends. It depends like in the country you're living in as well, or the inflation as well. If there's inflation, hyperinflation, stagflation, or deflation. So inflation is just the rise of price to a given time or specific time. So the first one, the key features of loans, like the interest rates. So interest rates vary based on the economic conditions. So in the case of economic conditions can be like inflations, the rise of price, or deflation, when the buyers or the consumers are afraid to purchase something in the hope of the price rate decreasing over time, like in the future. There's all about deflation. Hyperinflation is like the extreme cases of inflation. The price going high like 50% a month. There's all about hyperinflation. Stagflation is when there's the stagnation of money or the economy. There's all about stagflation. So lender policies as well can affect the interest rates, which means it's all about collateral. In the case of lenders, the creditors, they might ask you, you need to put something deposit, something like this, a cover, a pledge, or something like that. And the type of loan, so it depends on all of those. The interest rates depends on the conditions, economic conditions, lender policies, and the type of loan which you want to take. It can be business loans, student loan, mortgage, car loans, or vehicles. So in Europe, or most places as well, the rates or interest rates can be influenced by the European central banks, which is the ECB rates. So the central banks, I said, they're the ones who print money. They're the ones who set the interest rates as well. In the case of central bank in America, they call it Fed or federal banks. So countries in the Eurozone or EU, European Union, Eurozones, often have similar loan interest rates, while non-EUs or European zone countries set their own as well. So in the case of EU, because they say the European central banks are the ones who are controlling all the interest rates, they have the same interest rates all of the countries, the European zones countries. So the second key feature is like the credit score as well. In the case of business, the credit is crucial. In the case of student loan, the credit score, the GPA, is not needed. The grade point is not needed. So lenders access a borrower is credit worthiness. In the lenders, like the creditors in this case, they have to access you, the borrower, the debtor. Your credit is worthiness based on their or your credit score or credit history. Like in Europe, countries like the UK, United Kingdom, use credit reference agencies like the Expedient, Equifax as well, while other countries may use national systems. In the case of national system, like references as well. So they use, like in the UK, they use Expedient or Equifax to access you as the data, the borrower, they're going to access credit worthiness before they trust you with their money. So the third key feature is like the loan term as well. In the case of term is like the length which you're going to take before you repay. So the length, the term or the length of a loan depends on the type of a loan. So we have different types which I've cited there. So mortgage tends to be like a long term, up to 30 years, let's say 15 or 30 years. So you have more time to rethink or more time to repay. So whereas personal loans are shorter, like in the case of personal loans, like 1 to 7 years. So in the case of personal loans, can be like just take loan for vacation, loan for marriage, or just personal uses really. So short terms typically have higher monthly payments, but lower interest costs overall. So short terms, which is like the personal loans, have like 1 to 7 years. The case of mortgage, 15 to 30 years. The case of short terms typically have higher monthly payments, but lower interest cost overall or lower interest rates. So the fourth key feature is like secured versus unsecured. In this case, it is all about collateral, a pledge, a security, which you have to give before you give in the loans. Really, that's all about collateral, the meaning of collateral. So in the case of secured loans, we said the mortgage is an example for secured loan because the house acts as a collateral. Same as the car loans as well. The car or the vehicle acts as a collateral. When you fail to repay, the government will come and take the house, the car, whatever. The phones as well. Some people have take even loans on the phones. Like America, the case, extreme cases. So secure loans like backed by collateral, e.g. like a house or car. It can be a private or business assets, anything really. So it can be even the credit cards and money as well. So if you default, in the case of defaults, it's like when you fail to repay the loan or the money, the lender or the creditor can take possessions of the asset. If you default, fail to repay, the lender will come and take the asset back. They come take the house, the car back. There's a secure loan, so there's some type of trust between the lender, the creditor, and you, the debtor, the borrower. So in the case of unsecured loans, like not backed by collateral, the secure loans are not backed by collateral. Like student loans, they're not backed by collateral. Personal loans are not backed by the collateral. There's no trust in between the lender and the borrower, or the creditor and the debtor. So making them riskier and more expensive in terms of interest rates. So if there's no security, it becomes more riskier, less trust, and more expensive. In the case of interest rates, it skyrocket. Except in the case of students' loans. Except in UK, they say they have high interest rates compared to Germany. But some countries, many countries in Europe or all over the world, they usually like give zero interest rates on the student loans. So the fifth key features of loans is like repayment plans. You have to plan as well how you're going to repay, or the creditor that the one who have to set up the repayment plan. It can be monthly, per week, maybe, it depends. So most loans come with fixed monthly payments or repayments. In the case of fixed, it remains the same, constant throughout the end of your repayment term or the length of repayment. So which includes both the principal, amount, and interest. So in the case of principal, I explain all of those terms in the mortgage loans. In the case of principal, it's like the initial amount of capital that which you borrowed in the first place, or initial money borrowed. So that the interest rates is just a percentage, really depends in each country. It is variable, really. It is changeable. That's all about the principal and the interest rates or the interest. So in some cases, like loans can have flexible or changeable or variable repayment options, which means it's not fixed. It fluctuates with the market. You're going with the flow. So the 6 key features as well, and the last one is like regulations. In the case of regulations, it's all about the legal procedures or legal actions. So in the European or the European Union, the EU, loan practices are regulated to protect consumers or debtors or borrowers in these cases. For example, the Consumer Credit Directive ensures transparent loan terms and the right to early repayment across EU countries. So there's a set like a body which is like Consumer Credit Directive to protect the debtors or the borrowers in the case of transparent loan terms and the right to repay or the early repayment across EU countries. So in the case of early repayment, it's like you might get some penalty if you repay the loan early than the term given or the length of time given. If some people might say in 20 months, you have to repay all your loan. If you borrow, let's say 3K, it doesn't matter. They have to set the interest rates and they have to set the time of payment. Let's say 20 months time payment. If you repay early, like 20 months instead of 22, you repay like in 20 months. Or let's say you repay in the 18 months of 12 months, you finish all your loans. They will say you did something wrong. You have to penalize you, really. In that case, you get a penalty. So in that case, in the EU, they set like the Consumer Credit Directive to protect the borrowers. In the case of that, they have to put everything transparent, the term, the length of the loans, and you have the right as a consumer, the borrower, to early repayment as well. So the third point, we're going to look at the practical examples of a loan because I like to focus on practicality, the real world example. Let's say now you're the borrower or the debtor takes out 100,000 to 100k euros mortgage with a 4% fixed interest, which means this constant. So it's 4% fixed interest rates over 30 years. That's like the term or the length of repayment. So the monthly repayment or monthly payment would be around, let's say, 477 euros for the principal and interest. The principal is like the initial amount borrowed and the interest is the money on the top. So over the life of the loan, the borrower or the debtor would pay back 171,869 euros. So you borrowed 100,000 euros. Now you're repaying 171,869 euros, which includes 771,869 euros in interest. So you borrowed the initial or the principal money which you borrowed is 100,000 euros. Now you're repaying at the end of 30 years, which had like the loan at the 4% fixed interest. You're paying the full amount at the end, 171,869 euros, which means the interest of all the money that you borrowed is 71,869 euros. That's how it works. So the bank or whoever the lender is will benefit 71,869 euros at the end of 30 years. So the one will be losing. So the fourth point as well, we're going to look at the practical tips for taking out loan in Europe or anywhere really around the world. It's just the procedures really taking out loan. So if you want to borrow or if you want to take loan, now this I'll give the procedure step by step. So the first one, you have to compare lenders, which is all about research really. You have to compare the lenders. You have to look at lower prices. So it's all about comparison really, or research, doing own research as well as a borrower, as a debtor. So interest rates and terms or length can vary between banks, which can be public bank or private banks, individuals banks or government backed, credit unions as well, and online lenders who may have online lenders as well. So a short loan term reduces interest payments, but increases monthly installments or monthly payments. So therefore, it is important to compare before choosing. So you have to do your own research before choosing the type of loan which you're going with. So the first thing, you have to make the decision. What type of loan do you need? Is it student loan, business loan as a startup? Is it car loan or mortgage loan? Is it a personal loan? Then you do your own research comparison between the lenders. Are you going to a public or private financial? backup. So the second one of practical examples or tips, the second tips is like you have to understand the APR, which is all about the annual percentage rate, APR. So when you want to take a loan, the second thing that you have to understand is the annual percentage rate, which includes the interest rates and any additional fees or costs. So in the case of mortgages or the mortgage loans or secure loans, I did all the interest rates and the in addition cost as well. I explain what that means, which can be like you need the home insurance, which is like additional cost. You might need a property taxes as well, and the private mortgage insurance, the PMI. Those are like the additional cost. So you have to understand all the things, the payments which are included. So giving a clear picture of the true cost of the loan. So you have to understand or you have to get a clear picture of the loan really before you get all the feet in or you put all the eggs in one basket. So the third feature of or procedure of tips of taking loan, you have to check for early repayment fees. So you have to check if your lender will allow you to repay your loan early, like early repayment. Or if it is not allowed, then you have to go small, like baby steps. So in the case of loans, they simply put you like a prisoner. If they tell you 12 months or 22 months or 20 months, you have to follow the same 22 months before you finish your loan. Even when you have money, you just leave it there until the 22 months or 12 months or 20 months. Then that is the time which you can finish your loan. Or even if you give it 30 years, then in those 30 years, you cannot pay any earlier. Or let's say 15 years, when it was supposed to be 30 years, they might get a penalty. So you have to check for early repayment fees or costs. So some lenders charge fees or penalty if you repay the loan early. So that's when your research comes in. So look for loans with no or lower prepayment penalties. So those are the better one. So you have to look for loans with no or lower prepayment penalties. If you don't do research, you just go and sign the papers in the bank or credit unions. You don't even know, you start paying all your loans and finish early. Then you do come and say, why did you finish early? You get penalties and things like that. So the fourth tips is the loan insurance. The fourth procedure is like the loan insurance. In the case of insurance, it's all about taking cover in the case of unexpected, really. So in some European countries, it is common to take out loan insurance to cover repayments in case of illness or job loss. So imagine in the case of a loan, if you don't pay 1 or 2 months or 3 months, they will come. If it is mortgage, they will come and take the house. If it is a car loan, they will come and take the car or the vehicle. So if you have a loan insurance, that means it will cover you for repayments in the case of illness or when you lose or job loss, when you lose your job, or whenever you cannot afford to make the monthly payment or installment in this case. So what can we say, ladies and gentlemen, about all the loans, the car, the personal loans, this student loan, business loan, mortgages, which is like the house loan, and then we have car loans, it's all about the vehicles. So in the case of a loan as well, taking a loan, you become like a prisoner. Some loans as well, if you take an amount, like say 30 years, 50 years, or something like that, they'll not even allow you to go outside of the country. You cannot leave the country. You become like a prison until when you repay all your loans. So they would think like you're going to run away, you're going to do this, or you're going to change your name, you're going to do that. That's why the lender needs some type of a security, which is called collateral. They need a backup really when you fail to repay your loans. If it is the case of a house or car, they'll come and they take repossession of the house, repossession of the car, repossession maybe of the phone, if it is iPhone 6 or iPhone 16, new iPhones. So it's a usury is bad. So in the case of usury, they usually take if you take a quick loan, it's like there's a payday lending as well, which is like you say, I want to lend money whenever I get my salary, my wages, then I'm going to pay. So it's like a quick loan, and if you take quick loan, you have higher interest rates. In the case of usuries, like extreme cases of interest rates, unreasonable price which you have to pay. So in summary, ladies and gentlemen, about the loans, which is a summary really of all the videos of financial decisions, which you have to make wise decisions in this case. So if you take high loans, you have to be ready maybe to repay. Are you going to get a penalty for early repayment? Or are you ready to stay in the country and no longer traveling until when you finish all your loans? Or to become like a prisoner. So loans in Europe follow similar structures to other regions or countries across the world, or other continents as well, but with local differences in terms. In case of terms, it's all about the length of payment or repayment. interest rates as well, regulations like legal procedures or actions, and potential risk. In the case of risk, that's when it is crucial or important to take insurance as a cover. So loans are an essential financial tool for individuals, the case of personal loans, and businesses like business startup, business loans as well. So it is essential for borrowers. In the case, if you're a borrower, you become a debtor. So to research thoroughly, like doing research, it can be 2 days or even 1 week researching before you take a loan. Compare lenders as well. You do comparison, which one is a lower loan, which one accept early repayment, and fully understand the loan's conditions before committing or borrowing. Those are like the things which you have to understand before taking a loan. So you cannot be just impulsive because your friend went and take a loan, start a business. You want to take a loan as well and start a business, or you want to take personal loan and maybe go on vacation, marriage, or just anything personal or personal uses or something like that. So you have to be careful when it comes to loan. It is not a child's play, so you have to be serious in the case of that. So some people usually take loan just for home improvements, which can be, some people are taking loan for business, you're taking loan for home improvement. So you have to have a goal, a vision as well before going for loan. So ladies and gentlemen, this will be the end of financial decision making. I think I've cleared all your doubts in the case of loans taking. Mortgage is a secure loan as well. I've done the student loans, business loans, and the financial freedom. So go on my YouTube, you check all my playlists on financial decision making. I have a playlist on the business investment for beginners as well. A playlist on the spirituality or anything really to help you as a personal improvement, self-improvement, or self-realization. So thanks for watching. As usual, don't forget to like, comment, subscribe, and keep sharing the message. Ciao. Have a great day.